Karthik Ramana is the professor of business and public policy at the University of Oxford's Blavatnik School of Government and a fellow at St. John's College. An expert on government business relations, sustainable capitalism, and corporate reporting and auditing, Professor Ramana studies how organizations and leaders build trust with stakeholders. Karthik is the director of Oxford's Master of Public Policy program. He is also the founder and faculty chair of the Transformational Leadership Fellowship, a bespoke by-invitation program for senior leaders looking to reimagine their public service impact. Robert S. Kaplan is a senior fellow and Marvin Bower Professor of Leadership Development Emeritus from the Harvard Business School. Bob joined the HBS faculty in 1984 after spending 16 years on the faculty of the business school at Carnegie Mellon University, where he also served as dean. Bob co-developed both activity-based cost accounting and the balanced scorecard, widely recognized as seminal contributions to management theory and practice. He has authored or co-authored 14 books and over 250 papers, including 36 in the Harvard Business Review. Perhaps more importantly, in 2022, Karthik and Bob co-founded the E-Liability Institute with a mission to accelerate decarbonization innovations through rigorous greenhouse gas accounting. My friends, Karthik Ramana and Bob Kaplan.
Thank you, Mike, and thank you all for being here. So we've got a couple of objectives with this conference that we thought would be quite useful to lay out. In this first session, we recognize that there are going to be people in this room that know the liability method quite well, but there are equally people in this room that have just sort of, maybe skimmed the surface of it. And so we thought it might be useful to spend a little bit of time bringing everybody up to speed in what it is we mean by e-liability method, the e-liability approach to greenhouse gas accounting. Also give you a sense for what it is this institute is doing, this not-for-profit institute we've created to sort of drive this into practice. And then, of course, leave a bunch of time at the end of this hour we've got together for this first session for you guys to engage with us on questions and engage with this group. We think that it's really important that we brought this group together for the purposes of the next couple of days. And we want to use the time we've got together to engage in as much conversation, constructive conversation on the underlying e-liability method, get to know each other really well so that if we are going to be able to effectively improve the way we do this, we make substantial progress over the course of the next couple of days, right? So with that, we'll give you a brief overview of what we mean by the e-liability method. So at the heart of this is the idea that the current approaches to carbon accounting take a fairly top-down perspective. They start from the perspective of entities, and they look at how it is those entities might construct a picture of the emissions associated with their activities, both upstream and downstream. The challenge, of course, with that approach is that, most organizations, of course, they'll have a good understanding of who their suppliers and their customers are, but they won't know who their suppliers are. They certainly won't know how to go more than 2 or 3 layers up the supply chain, and likewise down the value chain. And that means that any kind of information system or accounting system that's generated with that approach is going to be effectively driven by a lot of assumptions. This is why you see a sort of prolific use of industry or regional average estimates. And once you move to that kind of direction where you're using industry or regional average estimates or any kind of estimate rather than actual transaction level data to construct an accounting system, that accounting system can't be really used for accountability. It can't be used for strategic decision making. So, Bob has spent a good bit of his career basically building accounting systems. 20 years ago, I used to teach accounting at the Harvard Business School in the required MBA program. And we used to teach basic things like the entity concept, the idea that if you're taking cash from one side of your pocket and putting it into the other pocket, that doesn't count as income. We would teach basic things like how to avoid double counting in an accounting system. And so as we look at the current approach to accounting for carbon emissions, part of what we've done in constructing the e-liability method is to use those basic principles from inventory accounting, from cost accounting, and apply them in the context of greenhouse gases. So that's really what the underlying approach approaches. Bob will spend a little bit of time taking us through the actual mechanics of how the e-liability approach works. That seat is free, Ulf. You can sit down right there. That's fine. Yeah. But what I want to do is also to give you just a sense of this institute that we've created. So I'll give you a bit of the genesis of the e-liability project. So about 2 years ago, a mutual former colleague of both Bob and mine was running a conference on carbon accounting. And she invited me to serve as the discussant on a paper on carbon accounting at this conference. And speaking frankly, I had not engaged in carbon accounting until then, but I did serve as a discussant in that conference really as a favor to the individual. And that was when I first read the Scope 3 standard. And I was struck by how it effectively deviated from what we saw as sort of pretty basic principles in accounting. And so that was the substance or nub of my comments at the conference that I was discussing that. And also I said, by the way, if the interest is in basically measuring emissions at the level of individual products and services and then aggregating them up to entities, then we know how to do this. We've been solving this problem in the context of inventory accounting for hundreds of years. So there is actually a way to do this. So that was the gist of the conversation. In the conference at the time was Bob Kaplan, and this was at the time of Zoom, so everybody was sort of online, and Bob was one of the images, the Zoom tiles on the screen. And he sent me an email afterward, and he said, "Karthik, I couldn't agree more with what you said. We should work on this." And it was just one of those emails that you almost just let pass. But then he said something really important. He said, "And this might be the most important problem I work on." Now, if those of you know what the kind of problems Bob's worked on before, you say, well, okay, this is the sort of email that gets your attention because he solved some important problems before. So we put our heads together and we put the paper out there. We sent it actually to Adi Ignatius over at Harvard Business Review. Normally there's a 6 to 8 month gestation cycle associated with the review process at HBR, but we heard back from the editors the next day, and they said that they'd like to publish the paper and they'd like to publish it in the next issue. So that's when we knew, okay, we might be onto something, so maybe we should spend some time on this. And so then the paper was published in November of 21, as Mike mentioned, and one of the first people to call us was one of the heads of one of the largest securities regulatory agencies in the world. And he said something really important to us, which was foundational in the creation of this institute. And he said, "Guys, this is a really interesting idea. Who's doing it?" And that's when we said, well, as far as we know, no one's doing it. We've just sort of dreamt this up in our offices. And he said, this is a problem. We can't build regulation around something that has never been tried before. So why don't you go get a few people to try it out? And then he gave us really specific instructions, which we've taken to heart. He said 2 things. Number one, it's really important that we understand that providing this kind of accurate transaction-level data at the level of individual companies and individual transactions aggregated up to companies changes the way managers make decisions in supply chains. Right? Because if we're going to go through this trouble and create a real-time accounting system, does it actually change behavior in supply chain? So you need to actually document and demonstrate that. And number 2, that the cost of this system is less than the benefits. Right? And this is a classic sort of regulatory challenge and a very fair challenge. And it's not just for-profit companies that are represented here at this event. We've got folks from the National Health Service, folks from Oxford University Hospitals are here. We've got a number of other public service hospital systems that are interested in deploying the e-liability approach. And we've got even a few governments that are interested in applying this approach to think about it from the perspective of entire governments. We were also very lucky that early on in the process, McKinsey & Company gave us some free consulting. I had, at that point, educated people who'd gone into careers in McKinsey Consulting for about 15 or 20 years. I saw myself as a supplier to McKinsey, but I'd never actually consumed McKinsey products, and this was the first time I consumed some McKinsey Consulting, and they did a fabulous job helping us build together a strategy for the Institute, so we're very grateful to them. And part of that process resulted in bringing on Mike Mahoney as the CEO of the Institute, in part because Bob and I have day jobs and we're both professors. And so our goal with the Institute is really to do a couple of things. Number one, to basically document those two pieces of information that the regulators asked us for in that critical call in November of 2021, provide as much evidence as we can to that effect. But importantly, also then create the momentum that's needed so that this then becomes a tipping point. We're not lacking for ambition. Maybe people will say we're perhaps hubristic in this, but our ambition is nothing less of changing the way the world works in this context. We think there's actually a better way in which we can do carbon accounting, and in the process of doing carbon accounting in this better way, we can actually decarbonize the way our economy works. And by that we mean physically reducing the number of molecules of CO2 and other greenhouse gases that are in the atmosphere, that are emitted and that remain in the atmosphere. That's the objective here. I mean, it's not accounting for accounting's sake, it's accounting to actually drive decision making. So that's really important, and it's an important objective of the Institute. And our goal as an institute is actually to create as much momentum as is necessary so that the regulators who eventually set the standards, whether this is the Greenhouse Gas Protocol, the International Sustainability Standards Board, the CSRD, or the Securities and Exchange Commission, or other regulators around the world, feel like this is the approach that they need to take forward. Bob and I have said we are academics. We have no interest in being standard setters. The sooner the standard setting community takes this on and runs with it, the sooner the Institute can fold, and we can go on to write our next papers. But until that happens, we as an institute are here to create the momentum. We're entirely not-for-profit. We have no commercial stake in this. We don't want any commercial stake in this. We are doing this because we think this is a way to actually help what is the most urgent problem on the planet today. So that's who we are. That's what we're trying to do. That's why this two-day conference is absolutely essential to get the work done. In the next session, or in the penultimate session, we'll also introduce some of our collaborators from Stanford University, but they're here. Mark Roston is our co-author on the paper on accounting for carbon offsets. I'm just pointing him out right now because there will be a lot of conversation around offsets, and so in the breaks we want you to reach out to Mark. Alicia is somewhere. There's Alicia, yes. Alicia is also from Stanford and now sits on the advisory board of the E-liability Institute as part of our team on driving this forward. And Professor Tom Heller is over there from Stanford Law School, also part of our team, our thought leadership team here at the E-liability Institute. So please reach out to any of us and as many of us as you can over the course of the 2 days we've got together, because that's the purpose of this conference. Now I'll turn it over to Bob to just give us a quick overview of the e-liability method itself, and then we'll come back.
Okay, well, thank you, Karthik. So it's great to have everybody here. We realized about 2 or 3 months ago that we knew half a dozen or more pilot sites. We're actively working with them, but the pilot sites didn't know each other. We thought, wouldn't it be great just to get us all in and be this community that's starting this great movement? And that was one of the motivations to organize this. So the existing approaches, you see listed at the top here, the Greenhouse Gas Protocol, environmental product declarations coming out of the EPA in the US, we all have the same goals. Okay, we share the same mission and the same vision, which is to reduce the quantity of CO2 equivalent molecules in the atmosphere. They were there before us. They naturally took as their unit of analysis big corporations, okay, because they felt they're the ones that would have the biggest impact, you know, whether it's BMW or IBM or Nestle, to mention 3 companies, name drop 3 companies in the room here, and says, okay, it's up to you guys to figure this out and solve the problem. And these approaches that they developed are really these top-down approaches aimed at the major, more end-use corporations to figure out what the carbon footprint is, not only of themselves, but of their supply chain. Without realizing this is basically impossible, because the combinatorics on this kill you. Any big company has thousands of products, and products have tens of thousands of components, and you have tens of thousands of suppliers. And this is just your upstream. And there's no way. You don't even know the names of 85% of your suppliers. So how can this possibly work, much less get audited? And because they were very concerned with the fossil fuel companies, they introduced the idea not only of upstream emissions, but downstream emissions. And you're responsible for those too, even though you have virtually no control over what your customers do with your product or service, much less could try to quantify this. So in a way, this is what Karthik and I were sensing 2 years ago as we wrestled with is a better approach. And the answer was yes. And the better approach was in a way obvious to us for the reasons Karthik described as accounting professors, because as we came to realize, accounting is a bottoms-up process. You know, you start with the original people who are producing materials or agricultural products, and then all the information rolls up the supply chain. And it happens so naturally you don't even think about it. It's just the most natural process, and no matter how complex the supply chain is, this works. So those are the foundations of the inventory accounting. And I also happen to work on developing a technique called activity-based costing, which basically solves the overhead allocation problem within a company, which says we have all these common expenses. How do we drive them in a causal manner down to the output products and services we produce? And that's what we do within each of the entities. We have all of the carbon emissions that we produce, plus those we have purchased from our suppliers and our input products and services, and we just have to assign them out to our end products and services. So those two basic principles got us going, and that's where we are today. And it solves the problems that you see on the top of this slide about the inaccuracy, the static nature, the complexity of the existing approaches. Even though, and again, we share the same goals with the people who created the Greenhouse Gas Protocol and EPDs, and they got there before us. So how this works is illustrated in this diagram. And let's just focus at the bottom for a while, because there's kind of two interesting parts of this, one of which I already said, that the process starts with the upstream supplier. You know, the mining of raw materials, and we'll hear some of that from the Hitachi Energy case study, and pick up the emissions that were produced to mine and extract those. And we can either record those and get the total emissions divided by the tons of material. An alternative is what Karthik uses, a tokenizing. You know, if we have a ton of ore, we divide it into very minute units, because eventually some little minute unit of that is going to end up in an iPhone or a Surface tablet. And that minute quantity has to carry the emissions profile all the way up that value chain. And then, they put it on a barge, a Maersk barge, and that's filled with lots of stuff, and that puts up it uses diesel fuel, so there's more emissions that come up in transportation, which we can allocate to all the stuff on the barge, either by weight or volume, whatever was the limiting factor on those things. And then it arrives at some intermediate manufacturer, and they now inherit the emissions that were produced in the mining and the transportation, and they make it into steel or refined copper, as we'll hear about. Gets back on a barge, more diesel fuel, more assignment, and it works its way out all the way through the final corporate producer and the end-use consumer. So that's the bottoms-up process. And what you see in yellow are just the T accounts, again, that we introduced in our first week of financial accounting, where we keep track of things. So what did we start with? The liabilities that were on our books, which we hadn't transferred in the previous period. How much did we purchase from all of our suppliers, including electricity suppliers? We don't require a scope 2 concept here. They look just like all the other suppliers. We produce our own emissions, scope 1, And using this activity-based costing-like approach, assign it to all of our outputs of products and services, and then the company that buys from us inherits that accumulated emissions. And once they do, we transfer it off our balance sheet and goes to the next purchaser as their purchased emissions. And they have the same process. They have their own scope 1, add it up, assign it out to their outputs, products, and services, and it just keeps going down the chain. So there's one other thing that actually came up yesterday when Alicia and Tom and Mark were, Karthik and I were talking to an asset manager active in the climate space, and they said, well, how does this differ from scope 3 when you're dealing with commodities? And like any good case method teacher, Karthik and I decided not to answer that question, but to raise the question he should have asked, which is, there's no such thing as a commodity anymore. When you think of a commodity, a ton of ore, a kilogram or a ton of palm oil that was grown, or 10 kilowatts of electricity, that's not all the same. It depends where was the item produced, how was it produced, how was it transported. And so even what seem like commodities, whether it's a barrel of oil or a kilogram of copper, are very different in their carbon content, depending upon how they were originally produced, how they were transported, and how they were processed. So every single item has its own carbon profile, and the EPDs and the Scope 3 standards to be implemented kind of suppress all the heterogeneity that actually exists in all these items that we produce and transport and then sell. And yet, even with how complicated that is, this simple process captures all that heterogeneity. It really gives us the accurate profile of if we want, of every input that we do. Now, you don't have to freak out. If you have 200 inputs, that seems like a lot. But as you'll hear in the pilots, this is more than the 80-20 rule. It's almost like the 1090 or the 595 rule. A very few of our inputs will generate the great bulk of our carbon profile. And so that's where we focus, because the rest of them are not going to matter that much. We can use the industry estimates without distorting the ultimate actual carbon emissions for our product and service. So just as we go forward, we always are focusing typically, certainly on version 1.0, on 1 to 5 of your inputs that we think might be 80 to 90% of the emissions in your output product and service. So in a way, we've already covered this. The bottom is the diagram of that activity-based costing process. We have raw material 1, raw material 2. That could be something like copper or iron ore, but it could be electricity. And your own production process, and through your own conversion process from inputs to outputs, we just assign out the emissions that have been accumulated and produced in this rational way, which would be subject to some verification at the local level that this was a reasonable way of assigning those emissions. And so we've covered all of these, except for number 3, which is if you actually take an action to remove CO2 from the atmosphere or purchase the rights that someone else has done this in a forest, or we'll talk about this tomorrow in sequestration, then you have the right to deduct the carbon you've removed from the carbon you've purchased and produced, which will end up giving a lower carbon footprint to the products and services you sell to your immediate customers. Okay, so that is a useful thing, but we have to be careful how we count those removals. And it turns out the accounting for carbon removals is more complex than the ones we're doing for e-liabilities, but still doesn't go beyond anything we don't teach in the first year course in accounting. We just mobilize a few more accounting principles to clean up that, and Karthik will go over that tomorrow. And the neat thing is you can get a single-page report. If you look at everybody's Scope 2 or Scope 3 reports, it's idiosyncratic. Every company has a different reporting mechanism, what they report, how they report. Your whole carbon emissions looks like an inventory footnote in a financial statement. Here's how much we had left over from the previous period, yet to be transferred out. Here's how much we purchased. Here's how much we produced, how much we assigned to our finished products and transferred out. And that less the carbon removals, legitimate, that occurred this period. So we actually we've solved the standard setting problem. Just produce this one-page report. And just aggregate up from all of your products and services for the entity which you could publish. And everybody's report should look the same. And this could define what they mean by net zero and whatever our other science-based targets are. Can be all done off this basically 10-line report on your CO2 equivalent emissions. More important, however, and Karthik talked about this, is fundamentally this is not just about reporting. It's about reducing. And for the first time, management has a real-time information system that they can use to redesign their products so they have less carbon inputs as we make them, to improve our production processes so we reduce our Scope 1 emissions, and who we choose as suppliers. So we can shift from high carbon intensive suppliers to low carbon intensive suppliers. And you'll hear a lot of those from suppliers that want to be doing that for end use corporations. So these are real decisions that organizations can make to lower their carbon content in their supply chain and their own operations. And if you want to start taxing, you have various indicators of where to tax. Now, we're not public finance people, economics. We don't work through the welfare economics of this. But you can tax, on the Scope 1, the things you add. You can tax on your whole emissions. And so, another idea that came up after the first article we wrote, but it showed up very vividly a month ago when Harvard Business School had its Climate Week, and I was giving a version of this talk, and tall Indian fellow, one of our alumni class of '92, was sitting in the front row, and he raises his hands in the middle and says, "This is a value-added tax." And I said, "No." He said, "You really understand. You got it." And he happened to be one of the people that put in the GST tax for all of India. So he had just taken this exact concept of what did you purchase, what did you add, what did you transfer, and uses that as the fundamental taxation basis for India. And he says India's they can do this because we've now educated people about what the GST is, General Service Tax. And we have software. And so we're talking with the people in India who fortunately are hosting the G20 conference this year. So it's a good time to be active with them. So I think I've talked about the dynamics, actual, we eliminate multiple counting, and the competition of shifting to lower cost suppliers, lower carbon suppliers, and lower carbon products and services. And so we want to be working with these pioneer companies that are seeking and achieving competitive advantage in their carbon emissions, to be ahead of the industry, and use this method both to drive their own performance as well as to compare it to their competitors who are lagging. So Karthik can talk about the pilots that we have here and the enablers that are going on. So.
Thank you, Bob. So, and we'll hear directly from the pilots, or some of the pilots, certainly over the course of the next couple of days. But this just gives you a sample of some of the organizations that we're working with. And in fact, since Mike joined this institute as the CEO, he's taken what were then, at the time, I think 4 or 5 pilots and turned it into 40 pilots. So really, sort of the goal is to get as many organizations as possible in various stages of actually embracing this, and equally also get intermediary organizations, whether software providers, assurance providers, and other kinds of intermediaries, to effectively allow this approach to be able to work at scale. So that's going to be absolutely critical to make this work. Our objective as the Institute is to work with organizations that are interested in learning how to put this into place. So that's what we do with these pilots. We provide our time pro bono. Again, we're funded by philanthropy. But in return for providing our time pro bono with the organization, we want to be able to disseminate those results widely. Now, when we disseminate the results, we're actually not so interested in disseminating the levels, which some might consider ironic, given that we are actually about accounting. But we say, well, those levels are eventually going to be disseminated by the company and through assurance channels and so forth. We're more interested in writing up the story, the process of how it is companies actually embrace this transformation. Because actually getting to where we want to get to is going to require a phenomenal amount of sort of a sociological transformation in the way businesses think about their climate process. Let me just sort of highlight one thing. Again, we'll come to this in much greater detail tomorrow when we talk about accounting for offsets. But e-liabilities, as the term suggests, focuses on one side of the balance sheet. So when you emit molecules of CO2 or other kind of greenhouse gases into the atmosphere, you create a liability, we argue, with nature. That is the e-liability. And what the e-liability accounting system does is effectively track the movement of that liability through supply chains, so that when you produce or when you purchase any product or service, whether it's the iPhone or whether it's, say, an hour of McKinsey consulting or whatever it might be, you are able to get an estimate, or more than an estimate, you are able to get a calculation that can be assured at a full scope level of what are the emissions associated with that product or service. But simply looking at the e-liability and using effectively that information to decarbonize operations is not going to be enough. We also have to focus on removals, which is to say extracting molecules of CO2 and other greenhouse gases from the atmosphere and permanently sequestering them. And as we will talk about more tomorrow, the current process and the current approach to doing that, basically voluntary carbon markets, they are effectively not working the way they should be. And they can be made much more effective through the use of good accounting. So the idea is to take the energy and the investment and the mobilization that we have around voluntary carbon markets, put some good accounting principles, again, very basic accounting principles on them, as a way to be able to use that rigor to channel energy into the things that matter most. So our dinner speaker tonight, my colleague Catherine Blundell, is an astrophysicist, and she will speak to effectively the physics, the atmospheric physics of the need for permanent sequestered removal offsets. And then we'll talk about the accounting of it. Once we've understood the science, we'll talk about the accounting of it tomorrow. So effectively, our objective, as I said, in pulling together this conference is to make clear that we are here to hope to change the world for the better, to make the world slightly better through the use of better carbon accounting. And that means a fairly ambitious agenda for an organization that currently has, it's a not-for-profit that currently has 5 people working for it, which is why we need all of you in this room to be part of that initiative. So pilots are going to be absolutely key to make this work. And pilots are not just the sort of the initial embrace and learning of the process, which is what we'll see shared by various companies, but then to be able to take that pilot adoption and actually scale it within those companies, so that it's not just them understanding the emissions of their own actions, but also them understanding how to work with their suppliers to decarbonize that. And we'll see this in a really nice detail with the Hitachi case. Once we've got built up a sufficient body of evidence across these pilots and sufficient momentum, hopefully in a couple of years we can get 100 of the Fortune 500 companies embracing these pilots. We'll be in a position to work with regulators to drive this into practice, and that's going to be really critical. Again, like I said, we have no interest in being standard setters or regulators, but we do want to make regulators aware that this is actually the way to do it. We have encountered now many people over the course of our conversations on e-liability. Without trying to overstate it, very few people have had any problem with the underlying logic of this, because if you did, you'd sort of basically have a question with the underlying logic of how financial accounting works. The challenge, of course, that people have with this is how are you going to get the regulatory system to change? And I think that is part of what we have to do as an institute, which is to build enough momentum to make this absolute for regulators to understand that this is absolutely the only way to do carbon accounting, and that's going to be actually quite a challenge. So if there is a reason why this project wouldn't work, it would be that we're not serious about climate change. We just don't want to measure this at the level at which we can sort of measure this accurately. We can get a full scope audit on it, and therefore hold companies to account for what is a net zero pledge. If we are serious about climate change, this is the way to do accounting. This is the only way to do accounting, and this is the way we've been doing accounting in the financial space for now 500 years. If this system is successful, then this system can effectively do for the measurement of emissions in the economy what the introduction of GDP did for the measurement of economic performance of countries in the 1930s and 1940s. Before that, we had sort of fairly vague and rough ways of understanding what were the economic performance of countries, but without having GDP as a concept, we didn't have a way of quantifying that. Now, GDP is by no means perfect, as we all know, but it is one metric that is on the tool of policymakers, that is one metric that is on the dashboard of treasuries, of central bankers, etc. You can imagine this kind of accounting as being another one of those metrics that can sit on that dashboard. And that's, I think, going to be really important. It's another dimension in which we need to be managing our societies, and that's what we'd like to